let's practice this principle using the following example. So essentially, like I said in the beginning, we're not really doing anything really new in this chapter, but we're going to put a lot of things together and use our valuation methods studied before in order to come up with the premiums, right? And we're going to do this by looking at several examples of how these premium principles, how they work. So we're going to start here with an example from the book. We're going to start with an endowment insurance with a term of n years. And we have a term of n years, and we've got a sum insured equal to S, which is payable at the earliest of the end of the year of death or at maturity, right? Premiums of an amount P are payable annually throughout the term of the insurance. They're paid at the beginning of the year. That's not explicitly written, but that's something we'll always assume. And what we need to do is write down the net future loss random variable, get the mean of this random variable, and as such, derive the annual net premium for the contract. Okay, so you can see that there are two sentences or parts of sentences highlighted in blue in my sheet. So we've got the endowment insurance with term n years, sum insured is S, and we've got the premiums P payable annually throughout the term of the insurance. So these are the two main ingredients that we need to balance in this example. So let's look at how we can do this on using the sheet, right? So here is my present value and variable of the benefits. So the insured amount is S. We're looking at an endowment insurance that is payable at the end of the year of death, right? The term is N. So we already learned in chapter 4 what the present value random variable of this endowment insurance is, if it works in annual time period. So we've got V to the power the minimum of kx plus 1 and n, right? Of course, here we don't have an insured amount of €1. We've got the insured amount equal to S. So this gives me the present value random variable. This is nothing new. This is what we learned in chapter 4, right? If we then continue with the present value random variable of the premiums, then we're going to use what we learned in chapter 5 in terms of life annuity due, term life annuity due, because the present value random variable of the premiums, the premium annually is denoted with P, and we can value this stream of payments, of premium payments, with a life annuity due with a term equal to n years. So its present value random variable is this annuity certain, of which the duration is stochastic, and the stochastic duration is the minimum of kx plus 1 and n. Again, this is nothing new. This is what we learned in chapter 5 for the term annuity due, right? So what we now want to do is use these two ingredients to write down the loss random variable at the present moment. So the loss random variable at the present moment, the L0n, there are no expenses to be taken into account here. We look at the future loss and we value this future loss at time 0. So we say what goes out minus what comes in. And this is here expressed as a random variable because the kx random variable is in here in my expression. So this is the present value random variable of the benefits minus the present value random variable of the premiums. Now, how can I get the expression for P, the premium, out of this random variable? Well, what I'm going to do then is I'm going to step from the random variable to its expected present value. And I'm going to say which premium should I charge such that the expected future loss is equal to 0, such that there is equilibrium between the EPV of the benefits and the EPV of the premiums. So that's my next step, calculating the expected future loss value. That's the expected value of the endowment insurance here and the expected value of my term life annuity due over here, right? And I already know how I can write down these EPVs, because that's something I learned in chapter 4 and chapter 5 as well. So I've got my expression here for the mean of the loss random variable using our traditional actuarial notation, where I'm relying on the EPV of the endowment insurance and relying on the EPV of a term life annuity due. I put this guy equal to 0, I solve for P, and this is the premium I should charge, technically, to have this equilibrium between the EPV of the benefits and the EPV of the premium income. So this is how you can calculate a premium. It's, in this case, it's a level premium because it stays constant, and the premium is payable throughout the whole term of the insurance contract. So the first premium is paid at time 0, the next one at time 1, and so on and so forth, and the last premium would be payable at time n-1. You see this? So this is a way how we can calculate the price, the technical price for this particular product. And this is what I then technically should charge to my policyholder who wants to sign up for this particular product. Any questions on this? Do you see this kind of reasoning going? So like I said, the very technical elements, we already covered them in the previous chapters. We're here just bringing that together in a clever way, so to say. Okay, good. Now what I will do on the next sheet is switch to a summation formula notation for this calculation. And why do I want to do that? Because of course with the summation formulas, you're always a little bit more flexible. And you can incorporate debt benefits that change over time. You could incorporate a term structure of interest rates, etc. So it's always good to have these summation formulas, which are underneath these symbols, to have them into your mind in case you need them, right? So let's do that. Yeah, and what I want to say as well is, before we step to the summation formulas, of course, we went here for the hard way to calculate the P, in the sense that we explicitly wrote down the future loss random variable. We explicitly calculated its expected value, put that equal to 0, and solved for P, right? You can immediately see that once you become quite familiar with this way of working, you would directly write down the EPV of the benefits, put it equal to the EPV of the premiums, and solve for the unknown premium symbol, right? So that's also that once you are familiar with this way of reasoning, this is the more direct way to find the premiums. So if I write it in full detail, just for your reference, if I look at the EPV of the endowment insurance benefits, then I'm working with the following summation formula. And then I've got S, the debt benefit. I've got the sum for K running from 0 to n-1. I've got V to the power K plus 1, because I'm going to pay my debt benefit at the end of the year of that. And the probability that I will have to pay the debt benefit at time K plus 1, that is KPX multiplied with QX plus K. So this is something we recognize from working with a term insurance product. Of course, we've got an endowment. So if my policyholder is alive at time N, then the debt benefit, or then the sum insured of S, will be paid at time N. So the present value of this S payable at time N is S multiplied with V to the power N multiplied with the N-year survival probability. Yeah? So this is in full detail what is underneath this international actuarial symbol for the endowment insurance, with a term equal to N and a sum insured equal to S. And you here see the typical notation that we developed for this international, for this endowment insurance in our international actuarial notation. That's for my benefits. Let's look at the premiums. If I look at the premiums, I'm working with a term life annuity due with a term equal to n years. So I've got P multiplied with the sum for K running from 0 to n-1 of V to the power K times KPX. In actuarial notation, that becomes the following. symbol. Okay, so I put these two equal to each other. I can solve for the unknown P, and like you see, here you get in full summation way of writing, you'll get the expression for P, which can then be summarized or written more compact using our international actuarial notation. Yeah, why do I refer to the summation formulas? Because, like I said, that's sometimes easy. If you're working with a changing interest rate, if you're working with a sum insured that is changing over time, and then it's often convenient to have these summation formulas ready. Yeah. So do you see the correspondence? The full detail approach with versus the approach where we just rely on the international actuarial notation. Any questions on this? Does this work? Okay, very good. I added one more thing, and that's how about calculating the EPV of the term life annuity due. I guess everybody knows it by now because you studied this for the midterm. But this is just a brief recap on how to value this term life annuity due. All right. Let's take a look then at the next example. So we're going to make it a little bit more difficult now. Because in the previous example, we essentially just had an endowment insurance. We had a constant stream of premiums. We put their EPVs together and solved for the unknown P. Now we're going to make it a little bit more difficult. And what are we going to do? We're going to pay the premiums monthly. So that's already more difficult than paying them annually. And we're going to play with the insurance benefit as well. So here you've got an insurer issues a regular premium deferred annuity contract to a life age X. The premiums are payable monthly throughout the deferred period, right? So there is a deferred annuity, and we're going to pay the premiums during the period of deferment. The annuity benefit is X per year. It's payable monthly in advance from age X plus on for the remainder of the life of X. So what do we want to know? Which premium should we charge? And here we want to charge the premium monthly, right? There are no expenses to be taken into account. So the complexity here comes from the fact that the premiums are payable monthly and that the annuity benefit is also payable monthly, okay? And now there is a big or an important difference to be made. And that is if you look at the X here, the X means it's the annuity benefit per year, right? So in total, over a year, we pay X. So monthly, we pay X divided by 12, okay? But if you look at the premium, yeah, the question is about calculate the monthly net premium. So if you say P is the monthly premium, then we pay 12 times P throughout 1 year. Yeah, so be careful with what the symbol exactly means. Does the symbol refer to the annual amount paid, or does the symbol refer to what you pay every month? And because if you mix up, then your answer is probably going to be wrong if you don't have that crystal clear. Okay, so let's give this a try. We're going to go for the easy way. We're going to go for the EPV of the benefits is equal to the EPV of the premiums, and we solve for the unknown premium. If you would like to do it the hard way, you'll need more time. Then you would write down the expression for the future loss random variable. You would take its expected value. You would put that equal to 0. You would solve for the level premium, right? That would, both recipes are exactly the same. But of course, the second one just takes you a bit more steps in between, so that takes you a bit more time to write it down like this. So what do we get as the EPV of our annuity benefit? So what I've got here is X, and then I've got the N-year deferred life annuity issued to an X-year-old that pays monthly, right? Where the X is referring to the amount that is paid over a period of 1 year. So the X is going to be paid in 12 equal installments. And what you see over here, that's what we learned last week about how you should value a deferred life annuity. Okay, so I'm going to elaborate a little bit more on that. We've got X per year, right? So not X per month, but X per year. That's important. It's payable monthly in advance because premiums are, no, sorry, this is not about premiums. It's payable monthly because the exercise tells us so. From age X plus N on, lifelong. So what we're in fact looking at is this life annuity due, working in monthly installments issued to an X plus N year old. But we need to get the value of this thing at time 0. So we need to discount from time N to time 0, taking the financial discounting into account and the survivorship. So we need to do actuarial discounting with V to the power N and PX. And this is what we learned in chapter 5 when we discussed deferred life annuities. So that is in terms of our EPV of the annuity benefits. Agreed? The next step then is how to value our premiums. So if we look at the EPV of the premium income, then we're going to work with 12 times P, and we're going to value this thing with a life annuity due with a term of N years that is payable monthly in advance. And the actuarial notation for that is indicated over here. So again, why do we do it like this? Because P is now referring to the premium per month. So that means 12P per year. The premiums are payable monthly in advance and throughout the deferred period. So that is between HX and HX plus 1, so during a term of N years. And that is the EPV that you need then. So what we do now is we put the EPV of the benefits equal to the EPV of the premiums, and we solve for the unknown but constant P. So putting these two guys equal to each other, solving for P, this is how I would calculate the monthly premium for this type of product. And of course, if you want to come up with some numerical result, you need to specify what the X is. You need to pick a life table. You need to pick an interest rate, and you need to do all these calculations in order to come up with a numerical expression for the P. And of course here, that's a little bit cumbersome because it's like, as we know it, it's working with these monthly annuities. That's typically a bit more work compared to their annual counterparts. Are there any questions regarding the reasoning that we build up to this point? So we wrote down the equivalence between the EPV of the benefits and the premiums. We solve for the unknown P, and that gives us what we need here. Yeah. Okay. Now, what happens if you want to take expenses into account? And if we look at expenses, then we're looking at initial expenses, renewal expenses, termination or claim expenses. Yeah. So this is everything that has to do with maintaining the insurance company, maintaining the insurance portfolio, the product that you're selling that costs money, right? So besides the benefits that you need to pay to the policyholder, you also want to make sure that these costs that you incur as an insurance company, that they are covered by the price that you are charging for your products, right? And so now we're going to reflect upon how to put these expenses and the benefits in your actuarial equivalence so that you can calculate premiums that also take these expenses into account. And the crucial thing here is to put the EPV of the expenses with the correct sign, at the correct side of your actuarial equivalence. Because like I said before the break, this often goes wrong if we do exercises on this kind of topic. So what you get here is that the equivalence principle now becomes the EPV of the benefits plus the EPV of the expenses is equal to the EPV of my premiums. So why do I put the EPV of the expenses over here with the same sign as the benefits? Because my premium should be sufficient to cover both elements, the benefits and the expenses. So that's how you should picture it, right? You want to charge a premium that is large enough so that both elements are covered by this cash flow stream of premiums. So let's do an exercise on this. We've got an insurer who issues a 25-year annual premium endowment insurance. The sum insured is 100,000. The policyholder has age 30, and the insurer incurs certain costs, certain expenses. So we've got the initial expenses of 2,000 euro. We've got 50% of the first premium and renewal expenses of 2.5% of each next premium. The death benefit is payable immediately on death of my policyholder. So what do I want to do? I want to write down the future loss random variable that takes the expenses into account. And I want to calculate the premium using a given survival model, using a 5% year interest rate. I want to calculate the premium that takes these expenses into account. Okay, so we've got a 25-year annual premium endowment insurance. So that means there is an endowment insurance. The duration, the term is 25 years. And if the exercise says how we've got a 25-year annual premium endowment insurance, that means that premiums are payable annually for the term of the contract. Yeah, so also our premiums are payable annually in advance during 25 years. What is also important that the death benefit is payable immediately on death. So that means I need to value my death benefit in a continuous time setting. And in magenta, you can read the information about the different expenses covered in this contract. And it's typically a little bit awkward to figure out. So here you read something about there is an initial expense of 2,000 euros. So that is payable at time 0. And then you've got 50% of the first premium. So the first premium is paid at time 0 as well. And 50% of that is included as a cost. Yeah? And then you've got renewal expenses of 2.5% of each next premium. So the premium at time 1, at time 2, and so on and so forth. And we need to come up with an equivalence so that we can calculate the premiums taking the costs and the insurance benefits into account. Is the question clear, or should we clarify a little bit on this? If everything is clear, let's solve this then together. So we've got S, the insured amount, 100,000 euro, that was given. We've got the age of the policyholder, 30 years, was also given. We've got the term of the insurance contract, 25 years, also given. And we use the symbol P for the premium. That's what we should calculate in this exercise. If I look at the present value random variable of the benefits, then I think about what I learned in chapter 4 on endowment insurances. And then I said, okay, the present value random variable, that's V to the power, the minimum of the X and N. That's for a €1 product, so here I need to multiply with S, because S is my insured amount. If I look at the present value random variable of the expenses, that's the new kid on the block. So that's something you need to carefully look at. And again, technically there is nothing new here, but you need to think carefully on how to write down this the present value random variable of the expenses. We got the 2,000 euro, which was a fixed initial cost, right? So that was something to be paid at time 0. So there is no discounting, there is no probability to be taken into account here. That's just the 2,000. Then we said what we need is 50% of the first premium as an initial cost. And afterwards, we're only going to have 2.5% of every premium as a cost to be covered throughout the rest of the contract. And now what you see over here is a trick that we already applied in earlier on. So instead of saying I'm going to take 0.5 times P, and then I'm going to take 0.025 P from year, from time 1 on, right? So from the second year on. What I'm going to do is I'm going to charge 2.5% of P throughout the whole duration of my contract. And then for the first year, I'm just going to add 47.5% of P to make sure that for the first premium at time 0, I include correctly a cost of 50%. You see that? So I'm going to spread. I'm going to say I need to 2.5% everywhere. And then temporary, for the premium that is payable at time 0, I'm going to add this 47.5%. Why do I do it like that? Because it's just easier to calculate the EPVs like that, because otherwise you have to work with a deferred life annuity with a 1-year period of deferment, and that's just a little bit harder to do, okay? So here you see, I'm going to value these costs with a life annuity due that works annually, which has as its term the N years, that's the duration of my contract. And then, of course, last but not least, I get the present value random variable of the premiums. Premiums are payable annually at the beginning of the year, throughout the duration of the contract, which is N years. So I should value them using what I know about a life annuity due with a term equal to N years. I put the whole thing together, yeah, and that gives me then the loss random variable, taking into account the benefits, the expenses, and then the premiums, yeah. And look at this expression. So the benefits and the expenses, they got the same sign, and that sign is opposite of the sign of the premiums, because benefits and expenses, that's what is going out from the insurance company to other parties, and the premiums, that's the cash that is coming into the insurance company. Last step, calculate the expected value of this random variable, put the expected value equal to 0, and solve for P. And as you may notice here, because the expenses are dependent on the premium to be charged, right? The solving for P becomes a little bit more complicated here compared to what we did in earlier exercises. So we say, let's put the expected value of the future loss equal to 0. And what we need to solve then is the following actuarial equivalence, right? We've got the EPV of the premiums, which is equal to the EPV of the benefits plus the EPV of the expenses. And once again, benefits and expenses are at the same side of my equivalence, and they got the same sign, because the premium calculated here should be sufficient to cover both the benefits and the expenses. Okay, we solve for P. We need to get a life table, we need to get an interest rate, we need to figure out what these EPVs are. That's something we learned in chapter 4 and 5. We solve for P and we find our level premium that should be charged in this particular example. Does that make sense? Questions on this? So, like I said, technically there is not much new here. It's more about putting the different building blocks that we've been developing, putting them together in the appropriate way here to do the valuation of the premiums. Yeah. I got yet another example here, which I think we'll cover as the last thing for today. So we're gonna speed up a little bit. So now we've got monthly gross premium for a 10-year term insurance with a sum insured of €50,000, payable immediately on death, issued to a life age 55, we've got the following basis. We've got a survival model, and we explicitly get the assumption that we can use UDD for fractional ages. We've got an interest rate given. We've got initial expenses, €500 and 10% of each monthly premium in the first year. And we've got renewal expenses equal to 1% of each monthly premium in the second and the next policy years. Right, so again, in blue is the benefits, and in magenta, I've got information about my expense structure. So I'm looking here at a term insurance, but the sum insured is payable immediately on that, so I need to work with continuous time setting. Okay. The premiums, they are not valued continuously, but they are valued monthly. Yeah? So I need to combine here continuous time benefits with monthly payable premiums and expenses. So that's a bit the challenge here in the exercise. So if I write down the EPV of the premiums, then we recognize what we already learned. So we say P is the monthly premium. So that means 12P is what I pay in terms of premiums over 1 year. And I need to value these premiums using a monthly life annuity due with a term of 10 years, right? Issued to a 55-year-old. So I'm quickly going to go back for the term. So the term was 10 years in this case. Okay, so that's the EPV of my premiums. Then I look at the EPV of my premium-related expenses. So I know that there was a €500 expense to be covered at time zero, an initial expense. And then there was something about premiums payable in the first year and premiums payable from the second year on, right? So let me quickly go back to the case here. So I had as the initial expenses 10% of each monthly premium in the first year. And then for the renewal, I had 1% of each monthly premium in the second and the next years. So I'm going to split that again in a clever way. So I'm going to say that that is 1% of each monthly premium everywhere. And temporary, in the first year, I need to charge an additional 9% of every monthly premium, right? So that's how I put it up together over here. So if I look at each monthly premium and 1% of that, that means in total 1% of 12 times P over the whole year, right? And I need to value this using a monthly life annuity due with a term of 10 years. That's my renewal expense, which is there in the first year and in the next years, throughout the whole duration of the contract. And then temporary, for the first year, I need to add another 9% of my monthly premium. So what do? I take 9% of the total premium paid that year, that's 12 times P, and I'm going to value this with a monthly life annuity due, but now only with a term equal to 1 year, because this component is only there in the first year of my contract. Okay? The €500, we already discussed it, that was my initial expense, my initial €500 to be paid. What if I look at the EPV of my insurance benefit? That was a term insurance issued to a 55-year-old with a duration of 10 years in continuous time. So I got a capital A here with a bar because the sum insured is payable at the moment of death, right? Putting it all together, I can say the EPV of my premiums is the EPV of my death benefits plus the EPV of my expenses. And I need to solve for P to figure this out.